like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's dive into a book that makes a pretty bold promise. A simple, almost mechanical formula to beat the stock market. We're talking about Joel Greenblatt's The Little Book That Still Beats the Market. Now, his whole argument is that successful investing doesn't require some genius-level intellect. In fact, he says it's so simple, a kid could get it. So today, we're going to put that to the test. We'll walk through his core ideas, one by one, and really see if this so-called magic formula holds up.
So everything kicks off with a really simple story about a kid, a sixth grader named Jason. And Jason, well, he's got a side hustle. He's figured out that he can buy packs of gum and then sell the individual sticks to his friends at school. Now, it sounds tiny, right? But believe me, the logic behind this little gum business, it's the exact same logic you need to understand the entire stock market.
Okay, so check out the math on this because it's kind of brilliant. A pack of gum with 5 sticks costs him $0.25. He sells each stick for $0.25. So he brings in $1.25, which means he makes a full $1 of pure profit on every single pack. Just by selling 4 packs a day during the school year, he's pulling in around $720. I mean, for an 11-year-old, that's not just pocket money, that's a real business.
Now, here's where things get interesting and where you come into the picture. Imagine Jason comes up to you and says, "Hey, I'll sell you half of my business." That means you'd get 50 cents for every pack he sells from now until he graduates. So, what's that worth to you? Seriously, think about it. How much would you pay right now for that future stream of cash? This isn't just some random question. It's the exact decision an investor has to make every single time.
And that right there is the absolute heart of it all. So many people think of the stock market as a casino, as gambling. It's not. When you buy a stock, you are buying a tiny piece of an actual operating business. It doesn't matter if it's a huge tech company or a corner store. The principle is exactly the same as buying a piece of Jason's gum empire.
Okay, so if we're buying a piece of a business, the next logical step is to ask, what kind of return should I expect? I mean, investing isn't a sure thing. There's always some risk involved. So there has to be some kind of baseline, right? A minimum return that makes taking that risk actually worth your time.
Well, think about your options. You could, stuff your cash under the mattress. But with inflation, that's a guaranteed way to lose money over time. You could put it in a bank, which is way safer, and you'll earn a little bit of interest. But really, the gold standard for safety is buying U.S. government bonds. It's pretty much the closest thing to a totally risk-free investment on planet Earth.
So let's just put a number on it. For the sake of this example, just like in the book, let's say that risk-free rate is 6%. Imagine you can buy a 10-year U.S. government bond, and it's guaranteed to pay you 6% every year. No drama, no guesswork. It's the safest bet you can make.
And that 6%, that becomes our yardstick. It's the hurdle rate. Any other investment you even think about making has to have the potential to earn you more than that. Otherwise, what's the point? Why would you take on the risk of owning a piece of a business if you could just get a guaranteed 6% from the government and sleep like a baby every night? You wouldn't. It just doesn't make sense.
So our goal is to find businesses that can beat that 6%. But here's the thing, the price you pay for that business is everything. And luckily for us, the stock market has, let's just say, a very colorful personality. His wild mood swings are precisely what create the bargains we're looking for. It's time to meet your new and slightly crazy business partner, Mr. Market. The legendary investor Benjamin Graham came up with this brilliant way to think about it. He said, don't think of the market as a cold, faceless machine. Think of it as a person, a guy named Mr. Market. And the thing about Mr. Market is, he's a manic depressive. Some days he's jumping for joy, convinced the future is bright. Other days he's curled up in a ball, certain the world is ending. And if you want to see his mood swings in real life, just look at a huge company like General Motors. In 1 year, there were days Mr. Market was so depressed, he'd offer you shares at a price that valued the entire company at just $30 billion. But a few months later, he was feeling fantastic, and he wanted a price that valued the very same company at $68 billion. That's more than double.
So this just forces you to ask a really basic common sense question. Is it really possible that the actual fundamental value of General Motors, all its factories, its brands, its workers, did it really more than double in value in just a matter of months? Of course not. The business itself is way, way more stable than the prices Mr. Market is screaming at you every day. And that is the whole secret. Most people see those wild price swings and they get scared. They see volatility and risk. But the smart investor sees something else entirely. They see opportunity. Mr. Market's irrationality is what creates sales. Our job isn't to get swept up in his emotional roller coaster, it's to patiently wait for him to have a bad day and offer us a wonderful business at a silly price.
Okay, so how do we actually do that? How do we systematically find these great deals that Mr. Market serves up on a silver platter? Do you need some advanced degree in finance or a wall of computer screens? Nope, not at all. In fact, Greenblatt argues you really only need to master two very simple, very powerful ideas. It's not about being a genius, it's about being disciplined.
Greenblatt uses this awesome analogy from the movie The Karate Kid. You remember, right? Daniel is spending all his time doing what he thinks are chores. Wax on, wax off, painting fences. He thinks it's pointless. But Mr. Miyagi is secretly teaching him the fundamental muscle memory of karate. Well, investing is the same way. We just need to master our own wax on and wax off.
First up, wax on. This move is all about one thing, finding a bargain price. We measure this with something called earnings yield. Now don't let the name scare you off. All it does is compare how much a business earns in profit to the price of its stock. A high earnings yield is a great thing. It simply means you're getting a lot of earning power for a low price. It means the stock is on sale.
All right, next is wax off. This move is about finding a genuinely good business, and for that, we look at return on capital. Again, it sounds complicated, but the idea is dead simple. It just asks, how good is this company at turning its own money into more money? A company with a high return on capital is a fantastic business. It's an efficient, well-run, profit-making machine.
And here it is. This is where it all comes together. The real magic isn't in either move by itself. The goal is not just to buy cheap companies. A lot of cheap companies are cheap for a reason. And it's not just to buy good companies, because even the best company in the world is a bad investment if you overpay. The whole secret, the entire magic formula, is to combine them. You systematically buy good companies at bargain prices. That's the whole game.
Now, I know what you're probably thinking. If it's really that simple, why isn't everybody rich? Why do so many Wall Street pros with fancy degrees get it wrong? And the answer is kind of amazing. It's that very simplicity that becomes your greatest weapon, your biggest advantage. So, let's just boil it down to the absolute essentials. What have we learned? 1. A high earnings yield is good. It means you're getting a bargain. 2. A high return on capital is good. It means you're buying a quality business. And 3, the most crucial part. The real money is made when you insist on getting both at the same time. Buy good businesses on sale. And you really need to let this sink in. Your edge as an individual investor isn't having a higher IQ or some secret information hotline. It's your temperament. It's your ability to be disciplined and stick to a simple, logical strategy year after year while the rest of the world is chasing fads and panicking over every scary headline. Which leaves us with one final, really big question to think about. If the core principles of making money in the market are this straightforward, this logical, why do so many incredibly smart, well-educated people struggle so much? The answer, I think, has almost nothing to do with intelligence and everything to do with things like patience, humility, and the emotional discipline to let a simple formula do its magic.
And that's our look at the powerful, common sense ideas from Joel Greenblatt's The Little Book That Still Beats the Market. It's just a fantastic reminder that sometimes the most effective strategy is the simplest one. Focus on quality, focus on price, and do your absolute best to ignore all the noise. You know, what if I told you that the very first secret to building real wealth could be learned from a sixth grader selling chewing gum? It sounds a little strange, I know, but that's the whole idea behind the book we're jumping into today. And it all kicks off with a really simple story.
So, can it? Can a kid's side hustle actually teach you how to get rich? It sounds a bit out there, right? But the author makes a big claim. If you can wrap your head around this one little business, you're already on your way to understanding a really profound secret about investing. So let's dive in and see if he's onto something.
All right, so let's meet our hero. His name is Jason. He's in 6th grade. And the way the narrator tells it, you'd picture this kid rolling up to school on a chauffeur-driven scooter, like some kind of mini business tycoon. The reality, though, is a little more 6th grade. Think dried breakfast on his face and a t-shirt that's a bit too small. But none of that matters because Jason, my friends, is in business. And his business model? It's genius in its simplicity. Jason buys a pack of gum. He takes it to school, and through his, let's just call it a very persuasive sales pitch, he sells every single stick of gum for the same price he paid for the entire pack. Okay, let's actually look at the math, because this is where it gets really powerful. Get this, he buys a 5-stick pack of gum for just a quarter, 25 cents. Then he turns around and sells each of those 5 sticks for 25 cents apiece. That's $1.25 in revenue. Take out his cost, and he's making a whole dollar of pure profit on every single pack he sells. If he sells just 4 or 5 of those a day, well, you can see how that starts to add up really, really fast.
So the narrator in the book, he turns this into a little math problem for his son. He asks him, hey, how much money do you think Jason could make by the time he graduates high school? And his son crunches the numbers. You got $4 a day, 5 days a week, for 36 weeks a year, times 6 more years of school, and you get a number over $4,000. All of a sudden, this little gum business isn't so little anymore. It's starting to look like a pretty valuable asset. And this right here is the pivot point. This is where the story goes from being a kind of funny story about a kid to a really powerful lesson. We're not just talking about Jason's daily cash anymore. We're trying to figure out the value of the whole dang operation. So this is the million-dollar question, or, well, the $1,000 question that the father asks his son. The deal is this. Jason will give you half of every dollar he makes from now until he graduates. But you have to pay him for that right today in one lump sum. So how much is that offer really worth? I mean, seriously, what would you pay for that?
Well, the son, his name is Ben, by the way, he immediately starts to get a little more careful. You know how it is? As soon as it feels like real money's on the line, you start pumping the brakes. He thinks, okay, hold on. Maybe Jason doesn't sell 4 or 5 packs every day. Let's be a little safer here. So he redoes all the math, but this time he uses a more conservative number, just $3 of profit a day. With that new, safer guess, he gets a different total. Over the next 6 years, the whole business would make around $3,000. So half of that, the piece of the business that's on the table, is worth $1,500. Simple enough. But the real question is that the price you should be willing to pay? Ben's answer is immediate, a quick, no way. And his reason for saying no is where the lesson really starts to click. See, it's not just about adding up the future profits, it's about figuring out what actually makes for a smart investment. And his logic is just pure common sense. He basically says, why in the world would I give someone $1,500 today just to get that same amount of money slowly trickled back to me over 6 years? There's no upside. There's no profit in a deal like that. Now, what's so amazing here is that this kid, Ben, he instinctively understands some really big financial ideas. Without even knowing the fancy Wall Street terms, he gets the time value of money. He knows $1 in his hand today is way better than $1 he has to wait 6 years to get. And he gets risk. Even with his safer guess, things could go wrong. Maybe the school bans gum, or another kid starts a competing business. So paying the full future value today, it just makes 0 sense. So his dad helps him frame the problem a different way. He says, okay, we agree paying $1,500 for a future $1,500 is a bad deal. But what if you could buy it for just $1? Well, obviously that's an amazing deal. You'd do that in a heartbeat. So the right price, the fair price, it's got to be somewhere between those two extremes. So after thinking it through, Ben comes up with his number, $450. To him, that feels right. Paying $450 today to get back $1,500 over the next 6 years, yeah, that feels like a good deal. He's basically asking for a huge discount on the business's calculated worth to make up for the wait and the risk involved. And this is where the whole thing comes together. This entire conversation about a 6th grader's gum business, it wasn't just some random brain teaser. It was all a setup for the big reveal, the real aha moment. And there it is. The dad drops the punchline. He looks at his son and says, great, now you finally understand what I do for a living. Of course, Ben is totally confused. He knows his dad doesn't go to an office to sell gum, but that wasn't the point at all. The whole point was to teach him the fundamental principle of his job. It's a strategy called value investing, and it is exactly what Ben just did with Jason's make-believe gum business. You do the work to figure out what a business is actually worth, and then you wait for an opportunity to buy it for a whole lot less than that number. Now, of course, this immediately brings up a very logical, very obvious question, and I'm willing to bet it's the same question that just popped into your head. Ben blurts it out. He says, wait a second, that sounds way too easy. I mean, think about it. If a business is truly worth $1,000, why on earth would any sane person sell it to you for $500? It seems like it completely defies logic, and answering that question is pretty much the entire point of the rest of the book. So how is it possible? Well, the author claims that you can buy businesses for half price all the time. But there's a catch. And the catch isn't what you'd think. It's not about being a math wizard or having some secret insider information. It's something else entirely.
So what's the catch? Well, it actually comes in 3 parts. First, he says you have to be willing to listen to a long story. Second, you have to put in the actual effort to really understand that story. And third, and this is the absolute key, you have to genuinely, truly believe that the story is true. The secret, he's arguing, isn't in your calculator. It's in your head. It's about your mindset.
The author even goes so far as to say that this book contains a magic formula for getting rich. But he keeps hammering home the same warning. The formula itself is totally useless unless you believe it's going to work. Without a deep, core belief in the story and the principles behind it, the method just falls apart.
And that's where we're going to leave this chapter. It really forces you to wrestle with a pretty fascinating idea. What if the real key to building wealth isn't hidden in some complex spreadsheet, but in understanding a simple story and then having the conviction, the guts, to believe in it when almost nobody else does?
All right, welcome. We're diving into what it really means to get started with your money. Now, before you even start thinking about stocks or bonds or any of that stuff, we have to talk about the very first step. And honestly, it's usually the hardest one, simply saving money in the first place. You know, this is the real battle, right? It doesn't matter if you have $5 or 500. It's just so much easier to spend it than it is to save it. That cool new thing you want gives you an immediate payoff. Saving? Well, that's about waiting. And let's be real, that takes some serious willpower. Oh man, I remember this from when I was a kid. Every single penny I got my hands on went to this one mail order company, Johnson Smith. They sold all the classics, whoopee cushions, itching powder, and my personal favorite, a very realistic-looking pile of fake dog vomit. That was my portfolio back then. But hey, I tried to be sophisticated about it. I told myself I was also buying, educational stuff. And the biggest, most educational thing I ever bought was a giant 10-foot weather balloon. What did it have to do with weather? I had no clue, but it sounded very scientific. So my brother and I, we got to work. First, we figured out how to reverse the flow on the family vacuum cleaner. And believe it or not, it worked. This thing inflated to its full 10-foot glory right there in our living room, which led us to a bit of a logistical problem. The balloon was now way bigger than the door. The only logical solution was to brute force it outside. And we did it. We squeezed that giant thing out onto the front lawn. But in our moment of triumph, we'd completely forgotten one very basic, very important little fact from science class. We'd filled it with warm air from inside the house. And the air outside, it was cold. And as pretty much everyone on the planet knows, hot air rises. The balloon just took off. So there we were, 2 kids frantically chasing this massive balloon down the street until it finally got stuck in a tree. And while the slide jokes that I don't remember the lesson, I really, really do. It was my very first taste of how easy it is to waste money on something that's literally gone in a puff of wind. Okay, so let's say you're smarter than I was. You've resisted the urge to buy your own weather balloon. You've actually saved up some money. Let's call it $1,000. That's awesome. So now what? Do you just stuff it under the mattress? Well, that's what we'll call the stinky mattress plan, and it's got a huge flaw. See, if you hide that $1,000 under your mattress, in 5 years, you'll still have $1,000. Great, but will it buy you the same amount of stuff? No way. That's because of inflation, this silent thing that's always happening in the background, making everything more expensive over time. So that money you're not growing, it's actually losing its power. The mattress plan is a bad plan. So that brings us to a much, much better idea. Plan B. Instead of hiding your money, you can let a bank use it. And here's the cool part. They'll actually pay you for letting them do it. That payment is called interest. Just look at the difference here. After 5 years, your mattress money is still just $1,000, and it buys you less stuff. But the money in the bank, assuming it earns 5% a year, has grown to more than $1,270. You didn't lift a finger. Your money did all the work.
So how does that happen? It's this beautiful thing called compound interest. In the first year, you earn $50 on your $1,000. Easy. But in the second year, you earn interest on $1,000 times and $50. You're earning interest on your interest. It's a snowball effect, and over time, it becomes incredibly powerful. Okay, the bank is a great start, but what if you wanted to cut out the middleman? What if you could lend your money directly to a big company, or even to the US government itself? Well, you can, and that's exactly what buying a bond is. It's essentially just a loan. When you buy a bond, you're lending your money to an organization, and they promise to pay you interest for a certain number of years, and then give you your original money back at the end.
But hang on. This brings up a really big idea.
A bank feels pretty safe, right? But lending your money directly to a company, well, what if that company gets into trouble? This gets us to the super important concept of risk.
And that's the whole game. If you lend money to a huge, stable company, the risk is really low. But if you lend to some brand new company, say Bob's Flapjacks and Pickles, the risk is way, way higher. So to convince you to take that bigger risk, Bob has to promise you a much higher interest rate. The key is you have to get paid for the risk you take.
This chart here lays it out pretty clearly. At the very top, the safest loan you can possibly make is to the U.S. government. Let's say it pays 6%. It's considered basically zero risk. A solid company like McDonald's has to offer you a little more, maybe 8%, to make it worth your while. And our buddy Bob with his pickles, he's going to have to promise a really high return to get anyone to take a chance on him.
Now, this whole idea leads us to what I think is the single most important concept in all of investing. Seriously, this is the foundation for every decision you'll ever make with your money. It's your personal golden rule. It's your benchmark.
And for our discussion today, that magic number is 6%. We're going to call this the no-risk rate of return. It's what you can get, practically guaranteed, by lending your money to the U.S. government for 10 years. You're taking on almost zero risk.
So why is this number so critical? Think about it. If you can get 6% with no risk at all, why on earth would you take a risk on anything else, like your friend Jason's new gum-making business, if it couldn't potentially earn you more than 6%? The answer is simple. You wouldn't. Any risk you choose to take has to come with the chance of a bigger reward than the safe option.
Okay, so let's just nail down the main points here. Number 1, stuffing cash under the mattress is a loser's game because of inflation. 2, banks and government bonds give you a safe, guaranteed return. 3, if you take on more risk with a company bond, you have to be paid more interest for it. 4, and this is the big one, every other investment has to be measured against that no-risk rate. And 5, a lesson for the ages, hot air rises.
And that's really the foundation of everything. It's not about complex charts or stock tips. It's about understanding this one simple number. So the question I want to leave you with is this. Now that you know what that no-risk benchmark is, that 6% baseline, how does your own financial plan measure up? Answering that is the real first step.
All right, hello and welcome. Today, we're going to tackle one of the biggest, most important questions in all of finance. How in the world do you figure out what a business is actually worth? You know, getting this right is absolutely fundamental to smart investing. So let's just jump right in.
So let's say you've been working hard. You've managed to stash away some cash. What do you do with it? Well, you could stick it in a savings account, or maybe buy some government bonds. And yeah, those options are super safe. But let's be real. They're also incredibly boring. The returns you get are so low they can barely keep up with the cost of living. You're just not going to build any real wealth that way. It's just not happening.
So what else is there? Well, you could, I suppose, take all your money down to the dog races. I mean, that's definitely more exciting. You get a little bit of a thrill. But as a financial strategy for your future, probably not the most brilliant plan. There has to be a better way, right? Something that sits right in between painfully slow and just plain reckless.
And here it is. This is the big idea. Instead of just lending your money out for a tiny little return, or frankly, just gambling it away, what if you could become an owner? You know, a part owner of a real, live, breathing business. A business that makes things, serves customers, and actually generates profits. This, right here, is the core idea behind the stock market.
Okay, so here's the game plan for today. We're going to start with what it means to buy a piece of a business. Then we'll figure out how to read its financial report card. That's the income statement. After that, we'll try to decide if we found a good deal. And finally, we'll talk about what an investor's real job actually is. Don't worry, we're going to use a really simple example to walk through the whole thing.
All right, let's dive into our first section, buying a piece of a business. Let's investigate a little opportunity here. So, I want you to meet Jason. He's a classic entrepreneur. Started small with a lemonade stand, and now he's built this incredibly successful chain of stores that sell nothing but gum. They're called Jason's Gum Shops, and let me tell you, business is booming.
So Jason's been so successful, he's decided it's time to cash in a little bit, maybe raise some capital to expand even more. So he's looking to sell half of his company, 50%, and he's put a price on it, a cool $6 million. Now, I know what you're thinking, $6 million, that's a little rich for my blood. But don't worry, he's got a plan.
See, instead of trying to find one person with a spare $6 million lying around, Jason does something really clever.
He decides to chop up the ownership of his entire company into 1 million tiny, identical little pieces. And these little pieces of ownership, we call them shares. It's a genius system, really, because it allows lots of different people, not just big-shot billionaires, to own a piece of the action.
Okay, so here's the offer on the table. The whole company is made up of 1 million shares. Now, Jason's smart, so he's keeping half for himself. That's 500,000 shares. He's still got skin in the game, right? The other half, the other 500,000 shares, those are what he's putting up for sale. And to hit his $6 million target, he's pricing each and every one of those shares at $12.
So this is the crucial point. You do the quick math, 1 million shares in total, and he's selling them for $12 a pop. Well, that means Jason is effectively saying his entire business is worth $12 million. That's his valuation. And that brings us, as potential investors, to the single most important question. Is he right? Is it really worth that much? Well, to answer that, we can't just take Jason's word for it. We've got to be detectives. We need to look at the numbers and see how the business is really doing. And that brings us to our next section. Decoding the income statement. This is where we follow the money. And lucky for us, Jason's given us the numbers from last year. When you look at one of these things, you always start at the very top, the top line. And wow, last year, Jason's gum shop sold $10 million worth of gum. I mean, that is a lot of bubble blowing. But, and this is really important, that's not his profit, not even close. That's just the total sales, all the money that came in the door. Now we have to start subtracting all the costs. I mean, you got to spend money to make money, right? So first, there's the cost of the actual gum they sold. That was $6 million. Then you've got another $2 million in all the other stuff it takes to run the business. We're talking rent, paying employees, marketing, keeping the lights on, all of it. So that's $8 million in total costs.
The math here is pretty simple. $10 million in sales, you take away the $8 million in costs, and that leaves you with $2 million. Now this number is called your pre-tax profit, or income before taxes. We're getting a lot closer to the real profit number, but there's still one more hand reaching into the cookie jar.
And yep, you guessed it. It's Uncle Sam. The tax man always gets his cut. Profitable businesses have to pay taxes. Simple as that. In our little example here, we'll say the tax rate is 40%. So you take 40% of that $2 million profit, and that comes out to $800,000. So here it is, the whole story laid out for us in what's called an income statement. You can see how the money flows, right? Sales at the top, subtract the cost of the gum to get gross profit, then subtract all the other expenses to get income before taxes. And finally, you pay your taxes, and what's left over at the very end, that's the magic number, net income, the bottom line. Last year, Jason's Gum Shops officially made a profit of $1.2 million. This is it, the moment of truth. We now have the two key numbers we need. We know Jason is asking for a price that values the whole company at $12 million. And we know from the income statement that the company actually earned $1.2 million in profit last year. So now finally, we can try to answer the big question. Is buying a share for $12 a good deal?
So to figure this out from our point of view, as someone thinking about buying a share, we need to break it down. We take that total profit, the $1.2 million, and we divide it by the total number of shares, which is 1 million. And what does that give us? $1.20. That means for every single share out there, the company earned $1.20 in profit last year. This is a super important metric, and it's called earnings per share.
So let's think about what that means for us. We pay $12 to buy one share. And based on last year, that share we now own earned $1.20. So what's our return on that investment? Well, we just divide the earnings, the $1.20, by the price we paid, the $12, and that gives us a 10% return. Hey, a 10% return in a year? That's not bad at all. But how do we know if 10% is any good? I mean, you always have to compare it to your other options. Remember our boring but super safe friend, the government bond? Let's say you could get a guaranteed 6% return from that with basically zero risk. So now you have a choice, a guaranteed 6% that's a sure thing, or a potential 10% from Jason's Gum Shops. Well, 10 is bigger than 6, so this is a no-brainer, right? This is a slam dunk.
Whoa, hold on, not so fast. Welcome to the investor's real job, because life, and especially investing, is never that simple. The math we just did is a fantastic start, but it's only the beginning. Now comes the hard part, the critical thinking that separates the amateurs from the pros.
The first and most important question is about the future. That $1.20 in earnings per share, that was last year. It's history. When you invest, you're not buying the past. You are buying a piece of the company's future. So, will they earn the same amount next year? Will they earn more? Or what if things go wrong and they earn less? Last year's profit is just a starting point for our guess.
And even after we make a prediction, how confident can we be in it? What if a new, super cool candy store opens up right next to Jason's busiest shop and steals half his customers? Or what if a study comes out that says chewing gum is bad for you? We have to think about the risks. Our 10% return is just a possibility. That 6% from the government bond, that's a certainty.
And finally, remember that investing is a long-term game. We don't just care about next year. When we buy a share, we're buying a piece of all the future profits for as long as that company is around. So we have to ask, will Jason's Gum Shop still be a great business in 5 years? What about 10 years from now? Could those earnings grow from $1.20 to maybe $2.40 or even higher? That potential for growth is a massive part of the whole calculation.
Okay, I can feel some of you starting to get a little nervous. This sounds complicated, but don't worry. This brings us to our final section, what you need to know. Let's just calm down and boil this all down to the core ideas we've uncovered. These are the key takeaways for your new investor toolkit.
All right, 3 things to burn into your brain. First, buying a share doesn't make you a gambler. It makes you an owner. You are buying a piece of a business's future profits. Second, because of that, figuring out what a business is worth is all about making a reasonable estimate of what those future profits will be. And third, to make taking a risk worthwhile, your potential return from that business has to be a lot better than what you could get from a sure thing like a government bond.
So what's the ultimate takeaway here? Your job as an investor is to be a detective, a gumshoe, if you will. You need to investigate the business, ask the tough questions, analyze the facts, and do your homework before you put your hard-earned money on the line. It's not about making wild guesses, it's about making an educated judgment. And with the basic tools we've just covered, you're now ready to start your first investigation.
All right, let's dive right in. Today, we're going to talk about a simple but really profound secret in the world of investing. It's all about a mindset that takes the one thing most people fear about the market, its crazy volatility, and turns it into your biggest advantage. You ready to see how the game is really played? Let's do this. So, everything really starts with this one almost ridiculously simple question. I mean, what if you could consistently buy something that's actually worth $1 for just 50 cents? It sounds like a fantasy, right? But this opportunity is very real. And to get how it works, we first have to take a little trip to a classroom.
So, I want you to picture this. You're in an Ivy League business school. It's the first day of an advanced investing class. The room is packed with some of the smartest, most ambitious people you can imagine, but they're about to get totally stumped by a question that seems, well, almost too simple.
The professor walks in, doesn't say much, just opens a newspaper to the stock listings. And he asks the class to just start shouting out names of some of the biggest, most well-known companies in the world. You know, the kind of blue-chip, household names you'd think would be the definition of stable and predictable.
First one up, General Electric. Yesterday, it closed at $35 a share. But then the professor points to the 52-week range. At some point in the last year, you could have bought it for just $29. And at another point, it was all the way up at $53. Think about that. For a giant bedrock company like GE, that's almost an 83% swing in what the market decided it was worth. Next, someone yells out IBM. And guess what? It's the exact same story. Yesterday's price, $85. But look at that range over the past year. A low of $55 and a high of $93. Again, this huge gap in what people were willing to pay for the exact same business, all within a 12-month period. And then they get to General Motors, and this one is even crazier. A price of $37 yesterday, but in the past year, it's been as low as $30 and as high as $68. The high price is more than double the low, and this is when the gears really start turning in that classroom. The puzzle starts to sink in.
So this leads the professor to the big question. With about 1 billion shares out there, the market was basically saying that GM was worth $30 billion at one point. But then, just a few months later, it was saying it's worth over $60 billion. I mean, did the company magically double its factories? Did it invent a car that runs on water? Of course not. So what in the world is going on here?
And that brings us right to the heart of the mystery, doesn't it?
Why do the prices of these huge, established companies swing so wildly when the actual value of their business, their factories, their patents, their sales, couldn't possibly be changing that fast?
Now, you'd think there's got to be some incredibly complicated PhD-level answer to this, and you'd be right. There are entire libraries full of intricate economic models, mind-bending math, and whole fields of social science dedicated to explaining this stuff. Basically, trying to make sense of what just doesn't seem to make sense.
But the professor's answer in that classroom, it was beautifully simple. He just said, who knows and who cares? Maybe it's just raw emotion driving these prices. Euphoria one day, blind panic the next. Maybe it's all just one big, sophisticated guessing game. The reason for the swings, it's not the important part.
And that is the absolute key takeaway. Stop trying to figure out why the market is so moody. Just accept the fact that it is. This volatility isn't some problem you have to solve. It's just a fundamental condition of the market. And it's a condition you can learn to use to your advantage. And that right there is where the real opportunity is.
So, to help us get our heads around this chaos, the legendary investor Benjamin Graham came up with this simple but totally brilliant little story. He asks us to imagine that we're in business with let's just say, a very unique partner. Let's meet this guy. His name is Mr. Market, and he's basically the stock market in human form. Think of him as your business partner, but he has these extreme bipolar mood swings. Some days he's on top of the world, convinced your business is the greatest thing ever. The next day, he's totally depressed, certain the whole thing is about to go bankrupt.
And every single day, without fail, your emotional partner, Mr. Market, shows up. He quotes you a price for your shares in the business, and he gives you 3 very simple choices. You can sell your shares to him at his price, you can buy his shares from him at his price, or, and this is key, you can just tell him to get lost and do absolutely nothing at all.
And this is where you get to flip the script. When Mr. Market is feeling euphoric and wildly optimistic, he'll offer you a ridiculously high price for your shares. That's your signal to maybe think about selling. But when he's panicking and depressed, he'll offer to sell you his shares at a ridiculously low price. And that's your signal to buy. His emotional breakdown becomes your financial opportunity.
Okay, so this all sounds great in theory, but how do you confidently take advantage of Mr. Market when he's in a bad mood? How do you know for sure that his low price is a real bargain and not just, a trap? Well, for that, you need a specific tool. You need a kind of secret weapon to protect yourself, and it's called the margin of safety.
So the margin of safety is actually a really simple idea. It's just the gap between what a business is truly fundamentally worth, based on its assets, its earnings, all that stuff, and the fire sale price that Mr. Market is offering you in one of his depressed funks. That gap, that's your protection. It's your buffer in case you're wrong.
Let's make this really concrete. Let's say you've done a ton of homework on General Motors. You've analyzed the business inside and out, and you've calculated that its real intrinsic value is somewhere around $70 per share. This is your number based on cold, hard facts and analysis, not emotion.
Then, one gloomy afternoon, Mr. Market comes knocking. He's in a full-blown panic about the economy, about interest rates, about everything, and he offers to sell you his shares of that exact same company for just $37 a pop. He's letting his fear dictate the price, which is almost half of what you've calculated it's actually worth.
And there it is. That $33 difference between your calm, calculated value of $70 and his panicked price of $37, that is your margin of safety. It's a massive cushion. I mean, even if your analysis was a little too optimistic and the company is only worth, say, $60 or even $50 a share, you've still bought it at such a deep discount that you are well protected and set up for a fantastic return.
So, the strategy seems simple enough, right? Just treat the market like your crazy business partner and only buy when he gives you a massive discount with a big margin of safety. But, as you've probably already figured out, putting that beautifully simple idea into practice, well, that raises some really tough questions.
I mean, the first and biggest question is this one. How in the world do you actually figure out that a business is really worth $70 per share? The entire idea of a margin of safety depends completely on your ability to confidently value a business. If you can't do that, you can't possibly know if you're getting a bargain.
And even if you do all the work and come up with a number, how do you know you're right? Valuing a business is all about making educated guesses about a future that is totally uncertain. And you're competing against thousands of Wall Street professionals who have armies of analysts and supercomputers all trying to do the exact same thing. How can a regular person even hope to compete?
In short, we've laid out this powerful way of thinking about investing, but we're left with this huge challenge. We need the skills to actually use it. As the source material puts it, pretty bluntly, without that skill, you wouldn't know a bargain price if it hit you in the head. The good news, though, is that this is a skill you can learn, and figuring out how to do that, well, that's the next and most important step on this whole journey.
You know, I'm a huge movie buff, especially when it comes to the classics from the 80s. And there's this one scene from a movie I'm sure you all remember that holds this incredibly powerful and kind of surprising financial lesson. It's a secret that I promise you, once you see it, it can completely change how you think about investing forever. Okay, so let's just jump right in. This is going to sound a little crazy, I know, but what if I told you that two simple repetitive motions, the kind of thing you might do on a Saturday afternoon, are all you really need to know to master the stock market? The key, you see, is hidden in a 1984 classic, The Karate Kid. So, for anyone who hasn't seen it, first of all, you should. But the story's pretty straightforward. A teenager, Daniel, he's getting bullied. He asks this old karate master, Mr. Miyagi, to teach him how to fight. But instead of learning punches and kicks, Daniel gets put to work doing chores. Seemingly endless, boring, menial chores. And the process is, well, it's a grind. First, he has to wax all of Mr. Miyagi's classic cars. Then, he paints this ridiculously long wooden fence. After that, he's on his hands and knees sanding this huge wooden deck. So after days of this, Daniel is just furious. He goes to Miyagi, totally convinced he's just being used for free labor and is completely wasting his time. And this is the magic moment. Miyagi just tells him, "Show me wax on, wax off." So Daniel does the motion, and Miyagi throws a punch at him, and Daniel, without even thinking, blocks it perfectly. Then Miyagi says, "Show me paint the fence." He throws another punch, and again, that simple up and down motion becomes a flawless block. It turns out the chores weren't chores at all. They were master-level training just in disguise. In the movies, there's this thing called the willing suspension of disbelief. We know it's not exactly real, but we go along for the ride anyway. And right now, I'm going to ask you for just a little bit of that, because I'm about to show you two concepts that are so simple, so basic, you might have a hard time believing they can actually turn you into a stock market master. But I promise you, they can. All right, let's get to our first move. This is our wax on, and it is all about one single thing: learning how to spot a bargain price. Because in investing, the price you pay for something determines a huge part of your future return. So how do we actually know if a stock is a genuine bargain? How do we measure that? Well, we use a simple tool called the earnings yield. Now, don't let the name scare you off. It's just the earnings per share for the year divided by the price you actually pay for that share. It answers a really important question. For every dollar I put in, how much profit is the company actually making on my behalf? Think of it like your immediate return on your purchase, the bang you're getting for your buck. So to make this super clear, let's just imagine a business. We'll call it Jason's Gum Shops. It's this wildly successful chain of 10 stores, and the owner, Jason, is offering us a chance to buy a piece of the action. So we open up the books and we see that last year, all of his shops combined made a total profit of $1.2 million. That's a pretty solid number, right? That's the whole pot of money the business earned. But to figure out what our piece of that is worth, we gotta break it down a bit. Now, Jason has divided his entire company up into 1 million equal shares. So we just do some really simple math. $1.2 million in earnings divided by 1 million shares. That means that each individual share gets $1.20 of that profit. That's our earnings per share, or EPS. Okay, so Jason is offering to sell us each share for $12. So what's our return? We take the $1.20 in earnings per share and we divide it by that $12 share price. What that gives us is an earnings yield of exactly 10%. For every $12 we invest, the business is earning $1.20 for us. And that is our wax-on move. That's how we spot the bargain. But let's really test this idea out. Imagine that the price stays the same. It's always $12 a share, but the company's performance changes. Which one of these situations would you rather be in? Take a look at this. If the company earned $1.20 You get that 10% yield we talked about. But what if its earnings doubled to $2.40? All of a sudden, your yield jumps to 20%. And what if it had a killer year and earned $3.60 per share? Now your earnings yield is 30%. The price you paid didn't change at all, but the return you're getting is massively different. The better choice is, it's obvious, right? So, our first rule of stock market karate is dead simple. All other things being equal, a higher earnings yield is always better. You want to buy a business that earns more money relative to the price you are paying. That is how you spot a bargain. Wax on. But just like Daniel Sand needed more than one move to win, so do we. Finding a bargain price is only half the battle. We also have to know if we're buying a good business or a bad one. And this is our wax-off move. For this, we use another really simple tool called return on capital. Now, this is totally different from earnings yield. We're not looking at the stock price anymore. We're looking under the hood of the business itself, at its operations. It answers the question, for every dollar that's been invested into the company, to build the stores or the factories, how much profit does it actually crank out? It's a direct measure of how good a business is at turning money into more money. So let's go back to our example. It costs Jason $400,000 to build and stock each new gum shop, but each store earns him $200,000 a year. That is an unbelievable 50% return on capital. Now let's meet Jason's buddy, Jimbo. It also costs him $400,000 to open one of his Just Broccoli stores, but his stores, they only earn $10,000 a year. That's a pitiful 2.5% return on capital. One is a money printing machine, the other, well, it's Jimbo's. And this might be the single most important lesson of all. The numbers tell you the whole story. Jason's business is a machine that creates enormous value. Jimbo's business is actually destroying value. He'd earn more money just buying a boring government bond. So the rule is simple. Don't give money to guys named Jimbo. So our second rule is just as simple as the first one. A higher return on capital is always better. You want to own a piece of a genuinely good business that's efficient and profitable, not a bad one that just struggles to create any value. Wax off. Okay, so you have now learned the two essential defensive blocks of investing. You know wax on, which is finding a bargain price, and you know wax off, which is finding a good business. So now it's time for the big reveal. It's time to put them together. And here it is, the master's formula. Step 1 is wax off. You find a great business, one that earns a high return on capital. That's your quality check. Then, step 2 is wax on. You wait patiently for the chance to buy that excellent business at a bargain price, a price that gives you a high earnings yield. Good business, cheap price. That's the whole secret. That's the entire strategy. I know, it might seem way too simple, right? Too basic to actually be true. You might be feeling like Daniel Sand did, thinking, come on, there has to be more to it than this. But the most powerful truths, they're often the simplest ones. And what can this simple little formula do for you? Well, according to the research this whole thing is based on, it can help you get returns that absolutely crush the pros. It has the potential to outperform academic studies and more than double the stock market's average returns over time. And the best part? It's a strategy you can do all by yourself, with low risk and, this is crucial, without ever having to predict what the future holds. Just like Daniel Sand, you have now learned the fundamental moves. The secret to investing isn't some secret handshake or some complex, mystical technique. It's about mastering the absolute basics and then just applying them with discipline over and over again. You now know how to find a good business, and you know how to find a bargain price. So the only real question left is, are you ready to start your training? Okay, let me ask you something. What if I told you there was a simple, almost mechanical formula for investing? A step-by-step recipe that, according to the historical data, could turn $11,000 into over $1 million in just 17 years. Yeah, it sounds like magic, right? Something that's just way too good to be true. Well, today, we're going to pull back the curtain and break down the logic, the history, and the frankly stunning numbers behind what's been called the magic formula for investing. Here's what we're going to cover. First, we're going to rewind the clock a bit to understand where this whole idea came from with a true investing legend. Then, we'll fast forward and look at a modern spin on that formula. After that, and this is the fun part, we'll dive into the jaw-dropping results it produced. Then we'll get into the nuts and bolts, exactly how it works step by step. And finally, we'll tackle the big question, the one that I'm sure is already bouncing around in your head. Is this thing for real? Is it really magic? All right, let's jump right in. To really get a handle on where this new formula comes from, we've got to go back. We need to meet the man who really started this whole line of thinking, the one and only godfather of value investing. We're talking, of course, about the legend, Benjamin Graham. Now, Graham understood something really fundamental. Most of us, everyday investors, we don't have the time or the PhDs to do super deep, complex financial analysis on every stock. So he set out to build something that was, frankly, revolutionary for its time, a simple, mechanical system that could get you great results and, just as important, protect you from those huge portfolio-killing losses. And what's so striking here is just how confident Graham was. I mean, this wasn't some fuzzy, abstract theory he was cooking up. Nope, it was a practical do this, then do that system. He basically said, look, just follow these simple rules, buy a whole basket of 20 or 30 companies that check the boxes, and that's it. Don't do any more work. Your results will be more than just okay. They'll be, in his words, quite satisfactory. So what was this big secret of his? Well, he called them bargain issues. And the concept, honestly, is almost ridiculously simple. He was looking for companies where the entire stock market value, the whole shebang, was less than the cash you could get just by shutting the business down and selling everything off. Selling the inventory, the buildings, collecting all the cash, you get the picture. It was the ultimate bargain hunt. And you know what? For more than 30 years, this formula worked like an absolute charm. But, and this is a big but, there's a catch. His strategy was really a product of its time, right? This was born in the aftermath of the Great Depression, when you could find companies trading for literally pennies on the dollar. Today's market? It's a totally different animal. Trying to find companies that meet Graham's super strict fire sale rules is, well, it's like trying to find a needle in a haystack. The old magic just isn't there anymore. And that sets the stage for a totally new approach. So, you see, that challenge created this fascinating new question. Could someone develop a new formula? One that captures the spirit of what Graham was doing, buying things for less than they're worth, but updated for the modern market we live in today. Turns out, the new formula boils everything down to two brilliantly simple ideas. First, you want to own a good business. Just think of a company that is incredibly good at turning every dollar it invests into pure profit. That's what a high return on capital is all about. And second, you want to buy it at a bargain price. This just means you're getting a ton of earnings for every dollar you put in, which is exactly what a high earnings yield tells you. So it's a simple two-part test. Is the business great, and is it on sale? That's really the core of it. And this, right here, leads us to the central, most tantalizing question of this entire thing. What if you actually did that? What if you built a system that did nothing but hunt for companies that were both high quality and dirt cheap? What kind of results would you even get? Well, the answer to that question is where this story goes from just kind of interesting to truly mind-boggling. Let's take a look at what a 17-year historical test of this exact strategy actually found. So from 1988 all the way through 2004, a portfolio of about 30 stocks picked only by this simple two-part formula would have returned an average of 30.8% per year. Just let that number sink in for a second. Over 30% annually for 17 straight years. Now, to put that percentage into real dollars and cents, let's say you invested about $11,000 in the overall market back then. You'd have ended up with a very respectable $79,000. Not bad at all. But with the magic formula, that same $11,000 would have grown to over $1 million. The difference is just absolutely staggering. And this chart really just drives the point home, doesn't it? You can see just how dramatically this strategy left the standard benchmarks completely in the dust. I mean, we're not talking about a small advantage here. The magic formula's return more than doubled the market average and the S&P 500 over this period. It's not even close. And this table, this gives us a fantastic year-by-year look at the journey. And it's really crucial to see that it was not a straight line up. I mean, look at 2002. The formula actually lost 4%, but it still lost way less than the market did. But then you see these absolutely explosive years that drove that huge average return. Like in 1991, it gained over 70%. And then coming out of that downturn in 2003, it roared back with a nearly 80% gain. It shows you the strategy has its ups and downs, but those up years were unbelievably powerful. So yeah, the results are impressive to say the very least. But how in the world does the formula actually pick these stocks? Let's pop the hood and see the simple machinery that's actually driving these incredible returns. Okay, so it's a surprisingly simple ranking system. First, you take this huge list of about 3,500 major stocks. Then you rank every single one of them based on quality. That's the return on capital. The best one gets a 1, the worst gets a 3,500. Then you do the whole thing all over again, but this time you rank them by price. That's the earnings yield. Finally, you just add the two ranks together. So a company ranked 100 on quality and 50 on price gets a combined score of 150. You then just go and buy the top 30 or so stocks with the lowest combined scores. That's it. And this is the really crucial point here. The formula isn't trying to find the single best company, and it's not trying to find the absolute single cheapest stock. No, it's looking for the best overall deal. A very good company that's selling at a very good price is going to beat a fantastic company that's selling at just a mediocre price. It's all about finding that perfect sweet spot where amazing quality and a bargain price overlap. Okay, so at this point, you are probably thinking the exact same thing the guy who came up with this formula was thinking. Hang on a second. This seems way, way too good to be true. And you know what? You're right to be skeptical. That kind of thinking isn't just healthy, it is absolutely essential when we're talking about investing. So let's just quickly retrace our steps here. We started with Ben Graham's brilliant original idea of a simple investment formula. We saw how the market changed and made it less effective, which created the need for something new. That led us to this modern formula built on those timeless principles: buy good companies at great prices. And then we saw the back-tested results of that very simple idea, which were, well, to put it mildly, just astonishing. Which leads to that last point. They seem almost too good. And hey, you don't have to take my word for it. This quote comes directly from the author who developed and tested this whole thing. His very first reaction was just total disbelief. He was convinced he must have made some kind of mistake because the numbers were just too powerful, too compelling. It's a reaction that completely validates our own skepticism. Which brings us right to the ultimate question, doesn't it? We've seen the mechanics, and we've seen the incredible numbers on a spreadsheet, but we haven't touched on the hardest part, the human element. You know, the psychological challenge of actually sticking with a system like this, especially during those down years we saw on the chart. So, is this really a foolproof system you can just set and forget? Or is there a catch? Is there a hidden human cost that these amazing numbers just don't show? Now that is the real million-dollar question to think about.
All right, let's dive right in. Today, we're asking a question that, almost feels a little dangerous to ask out loud. Is the magic formula for investing actually real? We've all seen the claims, we've heard about the incredible returns. But today, we're putting it all under the microscope to see if it really holds up.
I love this quote because it just hits the nail on the head when it comes to any investment strategy that seems too good to be true. It's so easy to look at amazing past results and just accept them. But the real trouble starts when we think we know something works without really digging into if or why. So that's what we're going to do. We're going to challenge what we think we know.
And that's really our mission here. You've got this formula on one hand that promises to find amazing companies at bargain prices with returns that just crush the market averages. But then you've got that little voice in the back of your head going, yeah, but what's the catch? So we're going to treat this like a proper investigation. We're going to take on the toughest objections one by one.
So here's the game plan. First up, we're tackling the biggest critique. Does this thing only work with tiny little stocks that nobody can actually buy in the real world? Then, we're going to ask if these incredible results were just some kind of fluke, a 17-year lucky streak. After that, we'll face the scarcity problem. Are these bargain deals so rare that they're basically going to disappear? And finally, once all the evidence is in, we'll deliver the verdict. Okay, let's get into it. First up is the biggest, most practical roadblock, what's called the size problem. This is where so many brilliant-sounding theories just completely fall apart when they hit the real world. So this is the heart of the question, right? Are these mind-blowing returns just something that looks good in a spreadsheet? A backtest on a computer that you could never ever replicate with your own real money? Let's find out.
So here's how the thinking goes. If a formula points you to a super small company, there just aren't that many shares for sale. So when you, a real person, try to buy in, your own demand starts pushing the price up. By the time you get your hands on the shares you want, guess what? It's not a bargain anymore. Your profit disappeared before you even owned a stock.
Well, right away, the first piece of evidence really throws a wrench in that idea.
The original test wasn't run on some obscure tiny companies. No, it was performed on the 3,500 largest companies on the major U.S. stock exchanges. And even the smallest company in that group was worth over $50 million. For any normal investor, that is plenty big enough to buy shares without budging the price one bit.
Okay, but let's push it. Let's really raise the bar here. Forget about companies that are just large. What about the giants? I'm talking about companies with market values over $1 billion. The stocks that the biggest mutual funds and pension funds in the world trade every single day. Surely the magic formula can't work on these super analyzed, super liquid stocks, right?
Well, have a look at this. This table shows what happened when the magic formula was used only on the 1,000 largest stocks, the billion-dollar and up club, over that 17-year period. You can see the magic formula's annual returns, the average return for all those same stocks, and the S&P 500 right next to it for comparison.
Now just focus your eyes on that number at the bottom of the first column, 22.9%. That was the magic formula's average annual return, even when it was only allowed to play with the biggest, most watched companies on the entire market.
And this just drives the point home, doesn't it? The formula's 22.9% wasn't just a little better, it was nearly double the 11.7% market average for that exact same group of stocks. So that whole idea that this only works on paper or with tiny companies, the data says, nope. Objection number one is pretty much busted.
All right, so the size of the company isn't the deal breaker. But that just brings up the next big question. Maybe the formula just got ridiculously lucky for 17 years straight. Let's look at objection number 2. Was it just a lucky streak?
And look, this is a totally fair question. You know how averages can be tricky? If you have one or two stocks that go up by 1,000%, they can drag the average of the whole portfolio way up, making the strategy seem a lot smarter than it really is. So, was this whole thing just a case of catching lightning in a bottle a couple of times?
To get to the bottom of that, you got to look at how the test was actually done. This wasn't some quick one-time thing. It ran for 17 years. Every single year, a new portfolio of about 30 stocks was picked and held for a year. And this whole process was done 3 separate times across 3 different groups of companies: the top 3,500, the top 2,500, and the top 1,000. So when you do all the math across all those tests for all those years, how many individual stock picks are we talking about? It's more than 4,500. That is just a massive, massive number of data points.
And that's the key, right? You might get lucky with one stock pick. Heck, you might even get lucky with a portfolio of 30 stocks for 1 year. But getting lucky over 4,500 times in a row for 17 years through all kinds of different markets, that stretches the definition of luck past the breaking point. It's just not a believable explanation.
Okay, so we've handled the size issue, we've handled the luck issue, but there is one more huge hurdle to clear. What if the formula works, but the bargains it finds are like an endangered species about to go extinct? This is the scarcity problem.
I mean, think about it. The whole point of the formula is to find those 30-ish companies that the market has gotten wrong and is selling at a great price. But what if the market gets smarter over time? What if there are only a few of these bargains out there to begin with, and as more people discover them, they just vanish? If that's true, the formula is basically useless long-term. So to figure this out, they ran a really clever experiment. This time, instead of just grabbing the top 30 stocks, they took the biggest 2,500 companies and ranked every single one of them using the magic formula's logic. Then, they split that list into 10 equal groups. Group 1 had the 250 best-ranked stocks, Group 2 had the next 250, and so on, all the way down to Group 10 with the absolute worst-ranked stocks. Then they just watched to see how each group did. And the results from this test are, well, they're kind of stunning. Look at how consistent this is. The magic formula doesn't just find a few winners. It seems to rank companies in order. The best-ranked group, Group 1, had the best return, almost 18%. Group 2 did a little worse. Group 3, a little worse than that. And this beautiful logical pattern just continues, almost perfectly, all the way down to Group 10, which pretty much made no money at all.
This chart just makes it impossible to ignore. I mean, look at that performance gap. The best-ranked stocks beat the worst-ranked stocks by over 15% a year, on average, for 17 years straight. And that tells us something huge. It suggests the formula's logic is fundamentally sound. And more importantly, it's not just finding a few rare diamonds in the rough. The entire group of top-ranked stocks does well. There's no scarcity problem. There seems to be an abundance of opportunity.
So, after putting this formula through this whole gauntlet of skepticism, where does that leave us? I think it's time for the verdict.
Let's just sum it all up. We've seen that the size of the company doesn't seem to be a barrier. It works on the giants, too. We've seen that with over 4,500 individual data points, calling it luck is a real stretch. And maybe most powerfully, we've seen that the formula seems to work in order, which means there should always be a big pool of high-potential, top-ranked stocks to pick from. The historical evidence, you have to admit, is pretty overwhelming.
But, and you knew there was a but coming, this is all based on looking in the rearview mirror. The past performance is crystal clear. The logic seems solid, the objections have been answered with some powerful data. And yet, the single biggest question is the one we can't answer with a chart. Will it keep working? Now that the secret's out, what happens next? And that's the real million-dollar question.
So let's talk about an idea that on the surface sounds completely backwards. We're going to unpack why a truly great investment strategy, well, it actually needs to fail. Yeah, I know, it sounds crazy, but stick with me here because I promise that by the end of this, you'll see how this strange paradox is not just true, it's absolutely essential.
To get our heads around this, let's start with a little puzzle from history. Think about this for a second. How in the world did the British Empire, the biggest, baddest global superpower of its day, lose a war to the American colonists? I mean, we're talking about a scrappy little group of farmers going up against the world's mightiest army. It makes no sense.
I mean, just look at this. It's almost comical. On one side, you've got the British Army, marching in perfect straight lines. They're wearing these bright red coats, basically making themselves giant human targets, and they're all firing at the same time. And on the other side, you've got the colonists, a total mess, just hiding behind trees and rocks, taking pot shots at those big red targets. It looks like complete madness on the part of the British.
But here's the kicker. That strategy wasn't stupid. It had worked, and worked brilliantly, for hundreds of years against all the other major armies in Europe. The problem was, the game had changed. The battlefield was different, and the very formula that made them unbeatable became the fatal flaw that led to their downfall. And this is where it gets really interesting, because that exact same logic applies to what we're talking about today, investing.
All right, so let's shift gears from the battlefield to the stock market. Imagine there's a magic formula for picking stocks. A system that's built on solid logic, with a long, proven track record of absolutely phenomenal, market-crushing returns. You could say it's the investing equivalent of that once invincible British Army.
But that brings us to a huge, glaring question, right? If a strategy is really that good, and everyone knows about it, it should stop working. It just makes sense. If we all use the same formula to buy the same bargain stocks, well, they're not going to be bargains anymore, are they? So how could it possibly keep working? And here it is. This is the big reveal, the twist in the whole story. The secret sauce that protects this formula, the very thing that allows it to keep on working, is that in the short term, it often fails, and fails spectacularly. That periodic failure you see, it isn't a bug in the system. It is the system's most critical feature. Okay, let's actually look at the numbers here. Month to month, this so-called magic formula loses to the overall market about 5 out of every 12 months. That is nearly half the time. You're basically looking at a coin toss in any given month. That's hardly the kind of track record that makes you want to bet the farm, right? And it doesn't get a whole lot better when you zoom out. Even on a yearly basis, the strategy will underperform the market about 1 out of every 4 years. Now really think about what that feels like. You follow this system perfectly for 12 solid months, and at the end of it all, you've made less money than your neighbor who just bought a boring old index fund. That's tough to swallow. But this is the real test. The system can and has underperformed the market for 3 consecutive years. Can you imagine that? 3 years of watching your portfolio lag behind, telling your family, no, just trust the process. It works in the long run, all while your friends are getting rich on whatever the hot stock of the day is. The psychological pressure would be just enormous. So I'll ask you straight up, be honest with yourself. Could you really stick with a plan that's been losing you money relative to everybody else for 36 months straight? The honest answer for most people is no. They just can't. And that right there is the entire secret.
All right, enough with the theory. Let's look at a real-life story of how this plays out. This first one is about an author who, get this, wrote a best-selling book about an incredible investment formula that he himself had created. He literally wrote the book on it. He was the world's #1 expert. So he launches a fund using his own genius strategy. But then it hits a rough patch. It underperforms for 2 of its first 3 years. The pressure mounts,
and the guy who invented the system sells his company and gets out. And what happens next? You guessed it. Over the next 3 years, the fund goes on an absolute tear, becoming one of the top performers out there. He bailed right before the big payoff.
Now, if you thought that story was something, wait till you hear this one. This is about a guy described by our sources author as the smartest money manager I know, a real genius who uses a similar, disciplined, long-term approach.
So after a decade of incredible success at another firm, he starts his own company. And wouldn't you know it, for the first 3 or 4 years, his strategy just doesn't work. It underperforms badly. And his clients, the people who signed up for those amazing returns, they started to panic. As the source says, they just ran for the exits.
Look at these numbers. He began with hundreds of clients who all claimed to believe in his long-term vision. But after a few tough years, only 4 of those original clients were left. 4. Everybody else jumped ship, probably right at the absolute bottom.
And just like in our last story, you know what happened next. The strategy came roaring back, and the firm's long-term record is now just spectacular. So what's going on here? These stories of failure, they aren't a warning sign to stay away from the formula. They are the very reason the formula is able to survive and thrive.
Let's just break the logic down step by step. First, a great long-term strategy hits an inevitable rough patch. Step 2, this tests everyone's patience. And most people, well, they fail the test. They sell. Step 3, this mass exodus of investors is what keeps the formula stocks from getting too popular and overpriced. And that leads to step 4. The opportunity is preserved for the handful of people who actually have the stomach to stick it out.
So you see, the failure isn't some unfortunate side effect. The failure is the secret ingredient. It acts like a gatekeeper. It's a psychological hurdle that weeds out all the people who don't truly believe in the process, which ensures the strategy never gets so popular that it stops working.
Let's boil it all down to the simplest possible statement. If the formula worked perfectly, every month, every year, without a single down period, everybody would use it. And if everybody used it, the bargains would disappear overnight and the formula would stop working. The pain is what keeps the magic alive.
So what's the big lesson here for you? What's your real edge in the market? It's not about finding some secret formula that no one else has. The formulas are already out there for anyone to see. Your true advantage, the one thing that really separates the winners from the losers, is having the guts and the conviction to stick with the proven plan through those incredibly painful periods when it looks like it's broken.
At the end of the day, it's really that simple. A great formula works precisely because it's so hard to follow. So the real question you need to ask yourself isn't about the math or the data. The question is about you. Do you have the psychological toughness to stick with it when everything in your gut is screaming at you to quit? Are you tough enough?
All right, let's just jump right in. I know. You're looking at that title and thinking, what in the world does that have to do with investing? And you know what? You're right. It is a completely bizarre title. But you gotta stick with me here, because where this crazy phrase comes from is the key to understanding one of the most powerful and, well, timeless investing ideas you'll ever come across. Just look at that for a second. Vomit under the 3M spaces and run. It sounds like nonsense, right? Like a secret code from some low-budget spy movie? And in a way, it actually was a secret code for me. It was our secret code for passing my 8th grade print shop class. Yeah, you heard me right. Print shop. See, way back in the day, before computers were everywhere, we had to learn how to set type by hand. You'd have this big box of metal letters, and you had to know where everything was. And to pass the class, you had to memorize the layout. So the bottom row of letters went V, U, T, then a little spacer called the 3M space, followed by A, R. So how did a bunch of us kids remember that? Yep, vomit under the 3M spaces and run. It worked. But today, with computers and digital printing, that knowledge is completely 100% useless, obsolete. And that difference is really the whole point of what we're talking about today. Some knowledge, like my print shop mnemonic, just evaporates. It has a shelf life. But other ideas, other principles, they're timeless. Think about something as basic as math. 2 plus 2 is always 4. It was 4 1,000 years ago, it's 4 today, and it will be 4 1,000 years from now. It doesn't matter who tells you otherwise. It's a fundamental truth. It's something you can build on with real conviction. So that brings us to investing. In a world that is just screaming with noise, with hot tips and new trends, and complex strategies that are in one day and out the next, what are the 2 plus 2 equals 4 principles? What are the bedrock ideas that we can actually hang on to, especially when the market gets choppy and it feels like everything is changing? Well, this is where an investing approach called the magic formula comes into play. Now, I'll be honest, the name sounds kind of gimmicky, I get it, but the engine behind it isn't magic at all. It's pure, simple, timeless logic. And the only way a strategy like this works over the long haul is if you understand that logic so deeply that you believe in it, with the same conviction you have for basic math. Because if you don't get the why behind it, you'll bail on it at the first sign of trouble. So that's our game plan for today. We're going to pull this logic apart piece by piece. First, we'll look at the core idea itself. Then, we'll figure out what really makes a company good. We'll see the incredible power of high returns in action, and then understand how the best companies protect themselves from competition. And finally, we'll cover how to get them at a bargain price. Then we'll wrap it all up with the key things to remember. All right, let's start at the beginning. That timeless logic. This is the foundation for everything else. And the great thing is, it's actually way more straightforward and sensible than you might think. Really, when you strip it all away, the entire strategy is built to do just one simple thing. Find above-average companies, and then buy them at below-average prices. That's it. I mean, it just makes sense, right? Who wouldn't want to buy a wonderful business for a cheap price? The real magic, then, isn't in the idea itself, but in how we define those two little phrases, above-average company and below-average price. So let's tackle that first part. We need a consistent, logical way to figure out what makes a company good or above average. How do we measure that? It all comes down to a metric called return on capital. Now, don't let the jargon scare you. It's a really simple idea. It just asks, for every single dollar a company puts to work in its business, to build a factory or buy inventory or develop software, how much cash profit does it spit out each year? A company that can generate a high number here is doing something really, really special. And to really get a feel for why this one number is so incredibly important, let's just tell a quick story. Let's imagine a little business called Jason's Gum Shops. So here's the deal with Jason's shop. It costs him $400,000 to build one store and get it all stocked up. And that one store, once it's up and running, makes him $200,000 in profit every single year. So you take that profit, the $200,000, you divide it by his investment of $400,000, and you get a 50% return on capital. Let me tell you, that is a staggering number. Most companies on the planet can only dream of returns like that. This is what an above-average company looks like in the wild. Okay, so at the end of year one, Jason is sitting on a pile of cash, that $200,000 in profit. What should he do with it? Well, he's got a few choices. He could just take the money and pay it out to himself and any other owners. That's option one. Or he could play it safe and invest it in some government bonds that'll pay him, say, 6%. Or there's a third option. He could take all that profit and plow it right back into his business to open a second gum shop. And this is where you see the real power of a high return on capital. Check this out. If he pays the money out, his earnings next year are exactly the same, $200,000. If he buys the safe bonds, his earnings inch up just a little bit to about $207,000. But if he reinvests that profit back into his own amazing 50% return business, his total earnings jump from $200,000 to $300,000. That's a 50% growth spurt in a single year, paid for entirely by the business's own success. That right there is the compounding machine that makes a great business so incredibly valuable. Okay, but wait a minute. You're probably thinking the same thing I am. If opening a gum shop is this incredible 50% return money machine, why isn't everybody and their brother opening one right next door to Jason? Because that's how capitalism is supposed to work, right? Those huge profits are like a giant flashing sign that says, "Free money over here!" Competitors would flood in. They'd open new shops, forcing Jason to lower his prices to compete. His amazing 50% return might drop to 40%. But hey, 40% is still fantastic, so more people jump in. And the returns fall to 30%, and then 20%, and they just keep spiraling down until opening a gum shop is just another average ho-hum business. So for a company to keep that high return on capital year after year, it has to have some kind of protection, a shield, a special advantage that keeps that downward spiral from happening. This could be a brand name that's so powerful people will pay extra for it. Think about Coca-Cola. Or maybe it's a product that's just way better than anything else, like the first iPod was. It could even be a strong competitive position, like eBay has, right? Where all the buyers and sellers are in one place, making it almost impossible for a newcomer to break in. This special advantage is what keeps the competition out and the profits high. Okay, so that's the first half of the formula. It's a systematic way to find these amazing businesses with some kind of protective shield. Now for the second and equally important part, how do we make sure we buy them at a bargain price? Well, this is where we look for something called a high earnings yield. And again, don't worry about the jargon. It's really just a fancy way of asking, is the company on sale? A high earnings yield means that compared to the price you're paying for a share of the stock, you're getting a really big helping of the company's profits. It is quite literally the definition of getting a good deal. And that's it. That is the whole timeless logic in a nutshell. The formula systematically finds companies that have a special advantage, which we measure with a high return on capital, and then it simply waits patiently to buy them only when they're on sale, which we measure with a high earnings yield. Buy good companies at cheap prices. It's as sensible and timeless as it gets. All right, so let's tie this all together. If you're going to walk away from this explainer remembering just a few things, what should they be? First off, remember that a high return on capital is not normal. It's rare, and it's a huge indicator of a special business. Second, that high return is what fuels the growth engine, allowing the company to reinvest its own money at incredible rates. Third, these companies almost always have some kind of special advantage that protects them from competition. Fourth, the formula is just a tool to find these great companies and buy them at bargain prices. And finally, and this is the most important part, truly understanding this logic is the only thing that will give you the guts, the conviction to actually stick with the strategy when times get tough. Which, of course, brings us all the way back to the beginning. That ridiculous phrase from my old print shop class is totally obsolete knowledge today, but the lesson it represents isn't. Some things fade away, but other things are timeless. And hey, if you ever find yourself in a time machine and have to set type by hand, now you know what to do. Because at the end of the day, the goal isn't to find the flashiest new thing or the most complicated strategy. It's to find a simple, sensible, logical principle that you can understand, that you can believe in, and that you can stick with for the long run. Because those are the principles that truly endure.
All right, welcome back. Today, we're jumping into Chapter 10 to really break down a super powerful investment strategy. We're going to get into the logic of why it works, look at the incredible numbers behind it, and most importantly, talk about the one crucial ingredient that you have to bring to the table to make it all work.
So here's our game plan. We're going to kick things off with a pretty wild story about a sailboat and a giant barge. Then we'll dig into the simple logic that makes the magic formula tick. After that, we'll get to the good stuff, the track record, and redefine what risk actually is. We'll finish up by checking on our old friend, Mr. Market, and talking about the ultimate reward that comes from being patient.
You know, to really get this, we have to start with a story. It's a personal one from the author that involves a sailboat, an unbelievably large barge, and a really important lesson about the difference between loving something and, well, actually being any good at it.
So our author absolutely loves sailing. He's passionate about it, but he's also the first to admit that his passion is, let's say, a little bit ahead of his actual skill. And that gap has led to some, let's call them memorable moments out on the water.
This particular story started with just a tiny miscalculation. You know, a simple mistake judging the wind and the current. But as anyone who's spent time on the water knows, those tiny little mistakes, they have a funny way of snowballing into something much, much bigger.
And that tiny mistake, it put his little sailboat just 20 feet away from a collision course with a barge that weighed 9 billion pounds. I mean, we're talking about something the size of 3 football fields. These things don't exactly stop on a dime. And when a vessel that big blasts its horn, let me tell you, all the usual sailing right-of-way rules just kind of go right out the window.
And right at that critical moment, the one thing that could have saved him, this little backup engine, it wouldn't start. Just picture it. He's yanking on this useless cord, trying to look calm for his wife, when, by some miracle, a gust of wind catches the sail and pushes them to safety just in the nick of time.
So here's why he tells that story. That feeling, that mix of loving something, really enjoying it, but also having that nagging feeling that maybe you're not an expert, that perfectly captures how so many people feel about the stock market. We love the idea of it, but deep down, we're not always sure we have a plan that can withstand a storm. Okay, now before we get into the really jaw-dropping numbers, it is absolutely essential that we understand the simple, logical reason this whole strategy works. This is the foundation for everything that follows.
Now, the author very deliberately did not show the amazing performance data up front, and there's a good reason for that. He didn't want us to just get starstruck by a bunch of good numbers from the past. He wanted us to first buy into the core idea, buying good companies for less than they're worth. I mean, it's just plain common sense, right?
And this right here is the absolute key. You have to believe in the why before you can truly commit to the what. Because if you don't understand the logic behind it, what do you think is going to happen the first time things get a little choppy? You're going to bail. You're going to abandon ship.
And that's where the trust in this strategy comes from. It's not some black box algorithm. It's a system built on a timeless principle. And maybe even more important, it's designed to protect you from making those classic emotional mistakes that sink most investors. Trusting the logic, that's what will get you through the tough times.
Okay, so now that we get the logic, let's look at the data. Let's see how this common sense approach actually holds up out in the real, messy, unpredictable world of the stock market. And honestly, the results are, well, they're pretty mind-blowing.
But first, let's get a reality check, because this is important. In the short term, this thing is not a magic bullet. The formula is actually going to underperform the market about 1 out of every 4 years. It can even lag behind for 2 years in a row. And I'm telling you, it is incredibly hard to stick with a strategy for 2 straight years while it looks like it's failing. This is where the patience comes in.
But, and this is a huge but, look what happens when you just stretch your timeline out to 3 years. The whole picture just flips on its head. The formula beat the overall market in a staggering 95% of all the 3-year periods they tested. 95%.
And if that wasn't enough for you, get this. Over all 17 years of data they looked at, there wasn't a single 3-year period where the magic formula lost money. Not one. It made money 100% of the time.
This slide really drives the point home. Let's talk worst-case scenarios. The absolute worst 3-year stretch for the formula was still an 11% gain. The market's worst 3-year period, a devastating 46% loss. I mean, the difference in protecting your downside is just enormous.
So when you see results like that, it really makes you stop and ask, what does risk even mean? We need to kind of toss out those complicated academic definitions for a minute and think about risk in a much more practical, common sense way, the way a real long-term investor should.
Forget all the complex math. For you and me, risk really just comes down to 2 very simple, very powerful questions. Number 1, what are the odds that I'm actually going to lose my money over the long haul? And number 2, what are the odds that my strategy is going to do worse than a simple alternative, like just buying an index fund? And when you define risk that way, using those simple, real-world questions, the conclusion is just unavoidable. The magic formula wasn't just more profitable, it was significantly safer. It gave you better returns with way less risk of losing your money over any time period that actually matters.
So that leads to the obvious question, right? If this formula is so logical and works so well, why on earth do these amazing bargains even exist in the first place? Well, to answer that, we need to go say hello to our old and famously moody friend, Mr. Market.
You see, in the short term, Mr. Market is an emotional basket case. He swings from total euphoria one day to deep depression the next, and in the process, he creates these totally irrational prices. And that's our opportunity. That's where the bargains come from. But here's the thing. Over the long term, he's actually a pretty rational guy. He eventually sobers up and gets the prices right.
And this return to rationality isn't just wishful thinking. It's driven by 3 really powerful, concrete forces in the market. First, other smart investors spot the same bargain you did, and they start buying. Second, the company's own management sees their stock as a steal, so they start buying back their own shares. And third, if a great business stays cheap for too long, another company will just come along and buy the whole thing in a takeover. These forces create a natural pushback toward fair value.
Okay, let's pull all of this together. We've got a logical formula that finds good companies at cheap prices. We have an emotional market that creates those opportunities, and we have powerful forces that eventually correct those prices. So what's the final secret ingredient? It's time.
Look, this price correction process, it's not instantaneous. It doesn't happen overnight. It can take weeks or months, sometimes even longer. But the history is pretty clear on this.
On average, you really only need to wait about 2 to 3 years for Mr. Market to finally come around to your way of thinking and reward that bargain purchase with a fair price.
So, in the end, it really all boils down to this, doesn't it? The formula. It does the heavy lifting of finding the bargain. The market, with all its built-in mechanics, eventually provides the reward. The only piece of the puzzle that's left, the only real question mark in the whole equation, is you. Can you provide the patience to let it all play out?
All right, let's get right into it. We've spent a lot of time talking about the magic formula, the logic, the low risk, the impressive returns. But, I get it. For some people, that's just not enough. You got that itch, right? You want to be the one picking the stocks. You want to be in the driver's seat. Well, if that's you, I'm not here to tell you not to. I'm here to show you how to do it without blowing yourself up. So let's talk about what it really takes to go beyond the formula. Look, there's a certain romance to it, isn't there? Forging your own path, using your own brain to uncover those hidden gems in the market. It feels like the ultimate test of your skill and judgment. But before we even start down that road, we have to be brutally honest about the dangers of going in unprepared. The author puts it in a way that is, well, pretty hard to forget. You just have to appreciate the bluntness of that. Running through a dynamite factory. I mean, that image just perfectly captures the stakes we're talking about here. This isn't some casual game. Going in blind is just incredibly reckless, and it's not just about losing money. It's about taking on massive, unnecessary risks. That's why having a plan, knowing exactly what you're looking for, is absolutely critical. And that, right there, is the big question for this whole explainer. How do you actually walk through that dynamite factory intelligently? How do you use the core ideas of value investing to your advantage, even if you've decided the strict by-the-numbers formula just isn't for you? Well, that is exactly what we are about to break down. So, first, we really need to understand why it's so dangerous in the first place. See, the problem comes down to a fundamental difference between looking at a single company versus looking at a whole portfolio of them. The magic formula has a secret, a kind of superpower that makes it work, and it's something that is really hard to copy when you're just picking 1 or 2 stocks on your own. So here's this fascinating paradox. The formula's biggest, most obvious weakness is that it uses last year's earnings to figure out a company's value. Now, we all know a company's real value is all about its future earnings, so that seems totally backward, right? But here's the secret weapon: diversification. The formula doesn't bet on any one company. It bets that the average of a whole bunch of statistically cheap, good companies is going to do great over time. And that is the absolute core of the problem for an individual stock picker. For one single company, last year could have been a fluke. Maybe they had a temporary problem, or maybe they had a huge one-time contract that made them look amazing. Relying on that single number can be so misleading. But when you look at a whole group of companies, all those individual weird situations, they tend to cancel each other out, and the average becomes a surprisingly good guide. And that's the magic number, right there. To get that powerful averaging effect to work for you, the formula says you need to own at least 20 to 30 different stocks. That's what ensures that if a few of your picks turn out to be duds, and some of them will, they won't sink your entire portfolio. You're playing the odds. It's a safety net that you just don't have when you only own a handful of companies. So, if we can't just rely on last year's numbers to pick individual stocks, what are we supposed to do? Well, this brings us to our first option, what we'll call the path of the expert. Now, this path is for the very, very few who are willing and able to do the incredibly difficult work of true business analysis. And the single most important skill an expert needs to have is the ability to figure out a company's normal earnings. This is not about looking at last year's report. This is about deeply understanding a business, its industry, its competitors, everything, to figure out what it can earn in a totally average, typical year, without all the short-term noise. And this is what that work actually looks like. You're not just taking a guess. You have to build a detailed case. You have to project earnings several years out, and then use those numbers to calculate your valuation. And then, and this part is absolutely critical, you have to be honest with yourself and ask, how confident am I really in these predictions? It's a tough, multi-layered process. And let's not beat around the bush. This is extremely difficult. I mean, even professional Wall Street analysts with teams of people struggle to get this right consistently for even one company. It takes a ton of time, real expertise, and frankly, a very specific kind of personality, which brings us to a very, very blunt piece of advice from the book. That's right. The author is basically saying that if you can't or won't do the kind of deep dive analysis we just talked about, you should just forget about picking individual stocks. Full stop. It's a really stark warning. And honestly, it's meant for the vast majority of us. But for that tiny minority who can do this work, something really interesting happens. Now get this, it's totally fascinating. If you actually do that deep, difficult research and you have a very high degree of confidence in your work, you don't need 30 stocks. You only need 5 to 8 companies, as long as they're in different industries, to build a portfolio that's both safe and effective. Your deep knowledge itself becomes the safety net, and it replaces the need for wide diversification. Okay, so what if you're not a deep dive, professional level expert, but you're also not quite happy just blindly following a formula? Is there some kind of middle ground? You bet there is. And this brings us to our third option, which is a bridge between those two extremes. Let's call it the path of compromise. The idea here is really simple, but it's also really powerful. You don't throw the formula out the window. Instead, you use it as your starting point. You let it do the heavy lifting of finding good companies at bargain prices, and then you apply your own research and judgment to that pre-filtered list. It's a way to stay in the game, but with a huge safety net underneath you. So here's how you actually do it. Step 1, you run the formula and get that list of top-ranked stocks. That's your hunting ground. Then step 2, you do your own homework, but, and this is key, you only let yourself choose from, say, the top 50 or top 100 companies on that list. And finally, you still build a reasonably diverse portfolio, somewhere between 10 and 30 of these pre-vetted stocks. This strategy really does give you the best of both worlds. You get the satisfaction of being an active stock picker, but you're not just starting from scratch in a universe of thousands of stocks. You're starting your search with a list that's already packed with good companies selling for cheap. It just dramatically increases your odds of success and makes sure you don't accidentally wander into that dynamite factory. So, there we have it. 3 very different paths. You have the pure formula follower, the dedicated expert, and the balanced compromise. The right choice for you really depends on your skills, how much time you're willing to commit, and just your general personality. So let's just quickly summarize the key differences. And this chart just illustrates one of the biggest differences beautifully: how much diversification you need. Just look at this. The expert, the person with the most knowledge, actually needs the fewest stocks. Their deep research is what provides the safety. Meanwhile, the formula and the compromise paths, because they rely less on deep diving into any single company, require a wider portfolio to let those law of averages work their magic. And just in case you missed it the first time, the author really wants to hammer this point home. And that little parenthetical, did I already mention that? It's there for a reason. He knows he's repeating himself, but it's because it's so important. For most of us, trying to be an expert stock picker without the skills is just a recipe for disaster. It is the single most important takeaway from all of this. This table pretty much lays it all out, nice and clean. The formula is for the investor who values discipline and a system. The expert path is for that tiny minority of true analysts, and the compromise is for the engaged investor who wants some control but within a smart, safe framework. Looking at this, you can really start to see where you might fit. It's all about being honest with yourself about your abilities and your goals. And I just want to leave you with this fascinating, kind of counterintuitive idea. We're always told that diversification means owning hundreds of different things. But for the true expert, concentration, owning just a few great businesses that you understand inside and out, is actually the real path to better profits and, believe it or not, even greater safety. So there you have it. You've got the map for navigating the world beyond a simple formula. It shows the dangerous path of the unprepared, the demanding road of the expert, and the sensible middle ground of compromise. The choice now is yours. You just have to be honest about your skills, your time, and your personality. Which path makes the most sense for you? All right, let's talk about Wall Street and the Tooth Fairy. It sounds like a strange combination, I know, but it turns out that little story we all learn as kids, the one where someone magically leaves money under your pillow, well, it's a belief a lot of us secretly carry into our financial lives. Today, we're going to pull back the curtain on some of those fairy tales of investing. There really is, isn't there? I mean, I remember it with my own kids, playing along, sneaking into their room to swap a tiny tooth for a crisp dollar bill. It's this comforting little fiction, a bit of magic we all agree on that makes things feel safe. The funny thing is, a lot of us never really stop believing in some version of that story, especially when it comes to our money. Because on Wall Street, some of the stories they tell sound an awful lot like fairy tales. You hear tales about wise guides who will protect your money, and secret clubs with magic formulas for getting rich, and this idea that the whole system is looking out for your best interests. So today, we're going to find out what happens when you finally grow up and learn the truth.
Okay, so here's our game plan. Think of it like we're taking a walk down Wall Street together. First, we're going to tackle the Wall Street myth itself. Then, we'll check out your first stops, the places most people go when they start investing. After that, we'll peek into some exclusive clubs and talk about why getting average returns is actually a pretty big deal. Then we'll see what's left, the only alternative, and finally we'll get to what I think is the most important part, the real hard part.
So let's get started. Part 1, the Wall Street myth. This is really about the foundational stories we're told, and let's be honest, the stories we tell ourselves about our money. And you know what? I'm just going to give you the secret right up front. The single most important takeaway from this whole thing is this. On Wall Street, money is not going to magically appear under your pillow. There's no one looking out for you, no one making sure you're okay. The plain, hard, simple fact is, when it comes to your money, you're on your own.
So if you're on your own, where in the world do you begin? Well, that brings us to part 2, your first stops. Our little walk down Wall Street is going to start exactly where most people's financial journey begins.
Our first stop seems like the most obvious one, right? The friendly neighborhood stockbroker. This is the professional who's supposed to hold your hand and help you figure out how to invest. For years, this was the person you went to if you wanted to get into the market. It really sounds like the perfect guide for our journey, doesn't it? I mean, it sounds like exactly what you need. Someone who listens to your goals, gives you some advice, makes a few suggestions. So what could possibly be the problem with having a friendly professional on your side? Well, here's the catch, and it's a big one. It's a hidden conflict of interest. See, a stockbroker gets paid to sell you things, a stock, a bond, whatever the product is. They don't actually get paid to make you money. So even if they're a perfectly nice person, their primary financial incentive is the transaction, the sale itself, not necessarily your long-term success. The whole system is built on commissions. Okay, so an individual broker has a built-in problem. So let's head to our second stop, an option millions and millions of people choose, the mutual fund. Now, on the surface, this looks like the perfect answer. You've got a professional money manager who pools your money with thousands of other people to buy a whole bunch of different stocks and bonds. You get instant diversification without having to be a stock-picking genius yourself.
I mean, seriously, a pro is calling the shots, your risk is spread out over tons of different investments. This has to be it, right? This seems like the perfect, bulletproof solution for the average person. It's got to be.
Yeah, unfortunately, no. And here's why. First, it's just simple math. A fund might get the market's average return, but once you subtract their fees, and there are always fees, your result is, by definition, below average. Second, every study shows that a fund that did great last year tells you basically nothing about how it's going to do next year. And finally, there's this weird paradox. When a fund does really well, money just floods in. It gets so big that the manager can't even use the same clever strategy that made it a winner in the first place. All right, let's keep walking. Time for part 3, exclusive clubs and average returns. This is where we look at the options that are supposedly just for the very wealthy. And we're going to see the surprising wisdom in just being average. So, what if you have a lot of money? Like a lot of money. Well, that takes us to our third stop, the hedge fund. You can think of this as the private, velvet rope VIP section of Wall Street. These are exclusive funds for the super rich with managers who can make all kinds of risky bets, often with borrowed money. Okay, so this has to be the answer, right? This is where the real secrets are. The special access, the high-powered managers. If you've got enough cash to get into this club, surely you've got a better option than the rest of us. Well, the reality is a little different. First, getting in the door is tough. You're looking at $500,000 minimum. Then you have these enormous fees. They'll typically take 1% of your money every single year, plus 20% of any profits you make. And because those fees are so juicy, thousands of new funds pop up. But the truth is, there just aren't that many brilliant managers out there. Most of these funds have zero chance of earning enough to justify those crazy high fees. Your odds of picking a winner are just incredibly slim. So after we visited the broker, the mutual fund, and even the super exclusive hedge fund, we end up right back at the same simple, harsh truth. And it's worth saying it again with feeling. On Wall Street, there ain't no tooth fairy.
And you know, this realization is what leads a lot of very smart investors to our final stop, the index fund. And this idea is so simple, it's brilliant. If trying to beat the market is so hard and so expensive, why not just match it? An index fund does exactly that. It just buys all the stocks in a big index, like the S&P 500, to mirror the market's return. And it does it for a tiny, tiny fee. And considering the market has returned over 10% a year on average for the last 80 years, settling for average is actually a pretty fantastic strategy.
But maybe you're sitting there thinking, yeah, but I don't want to be average. Even if it's a good average, I want to do better. Well, that brings us to part 4, the only alternative left. This is for those of you who want to know how you can actually do better than average.
So after this entire walk down Wall Street, after finally realizing that no one is going to magically make you rich, there's a pretty bold claim being made here. If you are determined to beat the market averages, there is really only one good alternative left for most people.
That alternative is to find a simple, systematic, rules-based investing formula, a strategy that is based on proven principles of value, one that's designed to take emotion and all that conflicted advice completely out of the equation.
But here's the big twist. Just having a formula isn't the magic bullet. And that takes us to our final and honestly our most important section, the real hard part. Because the true secret to success isn't the method you use. It's all about your mindset.
See, the real work isn't doing complicated math. It's overcoming 3 huge psychological challenges. First, you have to truly, deeply understand why your strategy makes logical sense. Second, and this is the one that gets almost everybody, you have to find the guts to keep believing in it, to stick with it, even when your friends, the so-called experts on TV, and all the scary news headlines are screaming at you that you're an idiot. And finally, there's just this simple hurdle of getting started. But if you can do that, if you can really internalize the logic and find the discipline to stick to a good plan through thick and thin, then you don't just have a strategy. You have a real path to building wealth. And that, well, that just leaves one pretty big, and I'd say pretty wonderful problem left to solve. What on earth are you going to do with all that money?
All right, let's jump right in. We're diving into Chapter 13 of the Little Book That Builds Wealth. And it asks a question that, let's be honest, we'd all love to have to answer. What do you do with a lot of money? I mean, it's the ultimate good problem to have, right? But this chapter, it takes that question on a really surprising journey. So here's what we're going to cover in this explainer. First up, we've got this mysterious forbidden formula. Then we'll see just how powerful it is. But after that, things take a turn. We'll look beyond just personal gain, talk about investing in our future in a totally different way, and even get into fixing a failing system. And we'll wrap it all up by talking about the choice you have once you've built that fortune.
All right, first up, a forbidden formula. The author kicks things off by teasing us with this idea like there's some big secret we're not supposed to be talking about.
And that brings us to the core question of the whole chapter. I mean, really, think about it for a second. What would you do if you had a lot of money? And I'm talking after you've taken care of the family, secured your retirement, bought the fancy car. What's next? The author here is basically saying, hey, this isn't just a daydream. If you follow this stuff, you might actually have to figure this out for real.
Okay, and this is where it gets kind of funny. The author makes this big show of saying, look, I'm not going to bore you with a bunch of stats. We're not going to talk about some magic formula for getting rich. And we are absolutely, positively not going to discuss compound interest. Yeah, right. Let's see how long that promise holds up.
And not even one slide. He immediately turns around and defines the very thing he said he wouldn't talk about. You know the drill. Invest a small amount, earn a return, keep reinvesting those earnings, and poof, you end up with a huge pile of cash. So much for the big forbidden secret, huh?
Well, the cat's officially out of the bag, so let's just embrace it and move on to our next section, the power of compounding. Let's really dig in and see just how magical this magic formula actually is.
So to illustrate this, the author gives us a really concrete example. We're starting with $28,000. Now, that's not a lump sum you have to come up with all at once.
It's a total amount that's invested over a period of a few years. And here's the breakdown of how you get to that 28 grand. It was based on the max IRA contributions back then. So you'd put in $4,000 in 2006, another $4,000 in 2007, and then it bumps up to $5,000 a year for the next 4 years. See, it's just a steady, disciplined plan spread out over 6 years. Totally doable for a lot of folks.
Okay, now hold on to your hats, because this is where it gets crazy. Let's fast forward 30 years. If that $28,000 gets a 15% annual return, it grows to $1.3 million. That's amazing. But what if you can find a 20% return, just a 5% jump? Look at that bar. It doesn't just go up a little. It more than triples to 4.3 million. And then a 25% return? It's just astronomical. We're talking $13.4 million. This is the whole point. The real magic isn't just time, it's the rate of return. A small difference there makes a gigantic difference at the finish line.
To really hammer this home, the author tells a story about the advice he gives to middle and high school students. He says if someone comes up to you and offers to sell you a piece of gum for a quarter, his advice is simple and direct. Don't do it.
And you might think, what's the big deal? It's just a quarter. But he's not worried about cavities or getting detention. No. His point is that that single 25-cent piece of gum, if you invest it well, could be worth more than $200 by the time you're, well, my age. It's a powerful way to think about opportunity cost, right? Every little bit counts.
So, okay, we've got the formula. We're all dreaming of turning 28 grand into 13 million. But right when you're getting hyped up, the author just slams on the brakes. He completely changes direction and asks a much, much bigger question. Is making money the whole story?
And he makes this really bold, maybe even controversial claim. He says that over 95%, 95 of all the daily trading on the stock market, it's probably totally unnecessary for the actual economy.
And here's why he says that. Think about it. When you go and buy a share of some big company, you're not actually giving your money to that company. You're just buying it from some other person who decided to sell. It's just a swap between two shareholders. The company itself, it gets nothing from that transaction. Now sure, the market is super important when a company first goes public and raises money, but all that day-to-day shuffling of shares, he argues it doesn't do much to help the actual business.
And get this, he even tells his own MBA students on their very first day of class, hey, I'm about to teach you a bunch of skills that could make you really, really rich, but in the grand scheme of things, these skills have limited value. Wow. What he's saying is that there have to be better, more important things to do with our brains and our time. So that really leads us to the heart of the chapter's message. If spending our days picking stocks isn't the most valuable thing we can do, then what is? The focus shifts to finding the highest possible return on capital, but not just financial capital. We're talking about something bigger.
And here's the big idea he throws out there. What if we took that same exact mindset we use for investing, that relentless search for the highest return opportunities, and we applied it to solving a huge societal problem?
The problem he zeroes in on is public education, and the numbers are just staggering. In a lot of major American cities, barely 50% of kids who start high school actually end up graduating. I mean, just let that sink in. He calls it a devastating waste of human potential. To put it back in our investing terms, that's like losing half your portfolio before it even gets started. It's a catastrophic loss of future doctors, scientists, artists, just gone.
So what's the solution? Well, his proposal is pretty out there, but it makes you think. He says we should apply the basic common sense principles of capitalism directly to our schools.
And this chart really lays it all out. It's simple, right? In the business world, if you perform poorly, there are consequences. If you do well, there are rewards. If your business is just plain bad, it fails. It closes down. And all that money, all that talent gets redirected to something that works better. But when you look at the public school system, he argues, those feedback loops just aren't there. Failing schools rarely close. Bad performance often has few real penalties. So, at the end of the day, these are the missing ingredients he points to. You need consequences for poor performance, you need the ability to fire teachers who aren't cutting it, and maybe more importantly, the ability to pay great teachers what they're truly worth. And you need a system that stops throwing good money after bad, and instead redirects it from failing schools to the ones that are knocking it out of the park.
And that brings us full circle to our final section. This is where the two big ideas of the chapter, the magic formula for personal wealth and this call for public good, finally connect. Because now you have a choice to make.
This image really says it all.
The author basically hands you the keys to the kingdom. He gives you this forbidden formula that could, potentially, build an incredible fortune for you and your family. But with that knowledge, with that power, comes this final piece of advice. It's not just about getting rich.
So, we'll leave you with this final thought. The whole point of the chapter isn't just about how to make money. It's about why. It's a challenge. Once you've used the formula, once the compounding has worked its magic, what comes next? If all that wealth is just a tool in your toolbox, what are you going to build?